All right, Cody, gonna switch it over to you, sir. Let's talk about lending.
Yeah, let's do that. Let's talk about money. That's always fun, right?
Absolutely.
Yeah.
I think it's an interesting topic that most everyone in this Brady Bunch window wants to talk about, for sure.
Yeah, absolutely. Do I need to go ahead and just share my screen here to
The
kind of get to
floor
what I
is
got?
yours, sir.
Yeah.
Yes, sir.
Okay. Cool. Let me get this shared here. Hope everyone is doing well today. Let me see.
Everybody's doing well except for your sharing skills on
Yeah,
Zoom.
yeah, yeah. Bear with me, everyone. Don't uh, don't do a lot of these. So,
Yeah.
um, yeah, no, yeah, excited to be here with everybody. And Jay, yeah, appreciate you having me. Um, yeah, like Jay said, I am a commercial mortgage broker. Name of my company is KBM Lending. I essentially have a platform of lenders that I work with, and then I go out and try to find folks like you, that need that need loans, and work on pairing you guys up with the best fit based on your situation and for your type of deal and things like that. So my presentation really is pretty short today. I'd like to do quite a bit of Q&A towards the end here. So if you have questions kind of as we're going, feel free to go ahead and just put those in the chat so you don't have to like remember it, until the end. Pop those in the chat, and then Jay's going to kind of help me with moderating it here. So yeah, but as far as kind of what we're going to go over today, what is asset-based lending, or DSCR loans? I'll use those two terms interchangeably. Um, DSCR loans that's become a really popular term over the last like 6 or 12 months. Asset-based lending and DSCR loans are the same thing though. So I'll kind of use those terms interchangeably. We'll cover misconceptions of asset-based lending, and then types of asset-based loans, and just kind of general terms. So a lot of emphasis on the general there. I get people that try to like nail me down to like what terms are, but as you all know, there's a lot that goes into that. So just kind of go over that generally. Um, Asset-based loans, just kind of in general, that they are loans that are made to your entity. So first and foremost, you do need to have an entity set up. That entity can be either a corporation or an LLC. A little bit of a pet peeve of mine is that most people refer to entities just as LLCs. Yeah, I'm sure you've heard people say, we need to get an LLC set up, or need to set up an LLC for that. So it's yeah, an entity is either an LLC or a corporation. So just kind of putting that out there for everyone. Like I said, kind of up on my soapbox here, as far as setting the record straight on that.
I didn't know that about you. I'm gonna now just start saying LLCs when entity should be
uh,
apparent. It's
I shouldn't have given you that ammo, should I have?
yeah, no.
Yeah. But yeah, you need to have an entity set up. You can certainly choose the structure from there, but the income of the property is really kind of the primary factor of of that loan being made. Um, you know, in relation, or sort of as opposed to with a conventional mortgage, your personal income, your debt to income ratio. If you're not familiar with what DTI is, but your debt to income ratio is really, like your ability to repay the loan on a conventional mortgage, is really kind of the driving factor around either you getting approved or not. Um, it's not the case with an asset based loan. The income of the property is really kind of the primary factor, and what lenders are looking at. Um, and then no limit as to the number of loans that you can have. So I'm sure all of you have heard, as far as conventional loans go, that 10 is the max that you can have, assuming that you're DTI can support that. With DSCR loans, because your income is not a factor, there's just not a limit as to the number of those loans that you can have. So if you've ever heard of an investor talk about having 50 rental properties or something like that, at some point along the way there, they sort of kicked the conventional mortgages and jumped over to the asset-based lending side, and that's kind of how they got to that point. So misconceptions of asset-based lending, that you don't need to have any of your own money. I get that question a lot. I get people that will ask, if it's really just based on the income of the property, and as long as it appraises for, like at least what my purchase price is, can I buy it just exclusively with a DSCR loan, without having to put any money into it? So that is not the case. You do need to have money to put into it. That you don't need to have sufficient credit. So asset-based lenders still will pull your credit. And I mean, that's one of the factors that goes into determining the interest rate that you'll get on the loan is your personal credit score. It's really your personal income, kind of like I talked about on that first slide there. Your personal income is not taken into account. So like providing like tax returns, things like that are not required. But they will still run your credit, and take a look at that as far as determining interest rate. That the loans are non-recourse, meaning if you default on the loan, that the lender is not going to come after you. That's also not the case. Non-recourse loans really become an option in the multifamily world when the loan is at least $1 million. That's at least kind of where the options start as far as that goes. But you will have to sign a personal guarantee, on one of these types of products. So so like I said, they're not non-recourse. Personal guarantees are tied to them. And then as far as types of asset-based loans, short-term, bridge, hard money loans, those are all really kind of just interchangeable terms. I'm sure most everyone is familiar with the BRRRR strategy. If you're going to buy a property that's in not great condition, and or the rents are well below market value, so there's some value add that needs to be done to that property, either through rehabbing it, and or raising rents. That's where you would utilize a short-term loan, to acquire that property, do the rehab that's needed, get the rents up to market, and then look to refinance that out onto permanent debt or a long-term loan. On a bridge loan, you can typically get into those for somewhere between 10 and 20% down on the purchase price. Most lenders will fund 100% of the rehab on a draw schedule. So meaning, like if you're able to get into one for like 10% down the purchase price, you do need to have some additional funds to start the rehab, and essentially the lender comes in behind you and reimburses you for what you do on the rehab. So rates on those are usually high single digits to sometimes kind of low double digits. Usually some type of origination fee also tied to it. 1 to 4% is kind of the range on that. So just kind of in general, though, DSCR loans are going to be slightly more expensive than conventional loans. That's really kind of the trade-off. You're gaining the kind of the flexibility of being able to buy as many properties as you want. But yeah, kind of the trade-off there is they are a little bit more expensive, with regards to origination fee and rate. So even kind of on the long term products, when conventional rates got way down, kind of below 3%, the lowest that I ever saw long term rates within the asset based world was about 4.5%. Was about as good as I saw on that side. So short-term rental properties, these DSCR loans have become really popular for short-term rentals. And I mean, really and truly, I mean, any asset type is where they can be utilized. Tying the property to your entity, versus to you personally. So, I think I think I'm at the end. Yeah. So that's like I said, really, that's just kind of high level overview. Pretty quick overview of asset based commercial lending there. So would love to just have a pretty solid Q&A session here if you guys have questions.
Yeah, guys, what do you have questions? Drop them in the chat, raise your virtual hand. I'll call on you. That way we're not talking over one another. And while you guys are getting those ready, I've got a few, Cody.
Cool.
By the way, I love DSCR loans. The closing process is so much easier. Like, for example, I'm going through trying to get a home equity line of credit on our primary residence. And oh my gosh, just the amount of documentation you have to provide up front. And then you think you're done, and they're like, no, we need a blood sample and a kidney. And then you think you're done, and they're like, oh, wait, no, we need your firstborn child. And I'm like, no, it's where we've done one DSCR loan. They're like, hey, let's run your credit. Let's see what your credit is. We need to see copies of your leases because this was for a long-term rental, and give them copies of that. They ran a credit, and that was pretty much it, man. We closed within like 23 days, I think is what it was. But
Yeah.
And speaking of credit, is there a minimum that you typically like to see for credit scores? Like, what kind of range are we looking at? I'm assuming it's just like a traditional loan where the better your credit, then the better the rate you're going to get, right?
Yeah, that varies some. 600 as kind of a general
Okay.
number. I've seen it a little bit below 600, like
Okay.
570 or 580. 700 and 730 are really kind of the two tiers as far as getting the best interest rate.
Better rates. Okay.
That you can. There's a pretty significant drop in interest rate if your score is at least 700, and then there's usually another pretty significant drop at 730.
Okay.
Anything above 730 really doesn't matter. So
Doesn't matter. Okay. So
yeah,
don't.
yeah. So
Okay. So don't try to improve your credit too. No, I'm just joking.
yeah.
All right. Nick's got a question. Is what kind of entity would you suggest for one of these DSCR loans? Uh, LLCs. There's only one type of entity, Nick.
Yeah.
Cody. No, I'm joking. I'm joking. LLCs or S corp, and from a lending standpoint, really, this is a question for your CPA and your lawyer, Nick. But
Yeah.
Cody, from a lending standpoint, do you like to see one over the other, or is it just an entity? It can't be in an individual's name, right?
Yeah, correct. Yeah, I was wondering if you were going to kind of give the full blown like legal disclosure there. We are not attorneys here at W2 Capital.
we're not we're not certified financial planners,
Uh,
CPAs, nor attorneys. That yeah.
yeah, it doesn't matter to the lender. No, if it's an LLC or a corporation, no, it does not matter.
Okay. Ross asked two questions. Number one, who do I contact? So Cody, if you want to drop your contact information in the chat there, recommend that. And she also asked, can I refinance her property? So Ross, I don't know if you want to add more information around the refinance, but Cody, what about that? Can you use a DSCR loan to refinance?
Yeah, absolutely. So yeah, lenders will offer, either a rate and term refi or cash out refinance. So yeah, you've got either option as far as that goes.
Ross, I just did a cash out refinance on a fourplex. It was in our personal name, refinancing it out into our business name with one of these DSCR products, and I'm telling you, it was just a smooth. To me, that's how banking should be, and I'm willing to pay the higher interest rate so I don't have to deal with all that other crap. because it was so smooth. Um, do you have to? Who is this? Scroll up. Erica. Erica, another membership strategist of the W2 Capitalist. So if you guys want to talk to Erica about what it means to be a member of the W2 Capitalist, go to w2capitalist.com/book a call, and I'll try to keep those shameless plugs to a minimum. She asked, do you have to have a lease in place, or would the DSCR loans go by what the unit will be able to rent for?
Yeah, good question.
Great question.
Yeah. So for a kind of that short-term bridge product that we talked about, no. I mean, obviously you're usually buying those vacant and in bad condition. For a permanent loan, though, yes. That is like the most important aspect. So for those who don't know, DSCR stands for Debt Service Coverage Ratio. Um, it's really kind of the equivalent to debt to income ratio for a conventional loan, but it just exclusively applies to the property. So yes, having that lease in place is what kind of satisfies that debt service coverage part of that. Um, so yeah, so for a long term loan, yes, yeah, a lease definitely has to be in place.
Yeah, I was amazed when we were looking for a short term rental. Talked to one of the guys who offered these DSCR products, and he's like, "Yeah, we can actually we don't we can just look at they use a couple different tools like AirDNA and whatnot,
Yeah,
and justify the loan based off of that." And I was
yeah,
blown away, and I'm like, "Man, this is where have you been all my life,
yeah.
DSCR? Let's go."
So yeah, that
Uh,
that is kind of specific to the short term rental world.
yeah, yeah.
Yeah. So I guess I could have clarified that, Erica. If it's a short term rental, then they can project it. Kind of based on some of those tools. But if it's going to be a long term rental, then they want to see leases in place. Yeah.
Uh,
Right. Yeah.
Puneet asked, "What's the range for percentage down payments in the DSCR lending space?"
Yeah. So if it's a short term product, 10 to 20% of the purchase price. Like I said, they'll usually cover 100% of the rehab. If it's a long term loan, usually 20 to 30%. The constraint there, um, so in a lot of cases, your credit score and um, the DSCR of the property. So lenders actually go about assigning like a number to that DSCR. You essentially just take the income of the property, divide it by the PITI, principal, interest, taxes, and insurance, and whatever that works out to is kind of the strength of that DSCR on the property. So the higher that DSCR number, the higher your credit score. Usually the lender will go higher on the leverage point. So if your credit's strong, the DSCR usually needs to meet like a 1.20. Then 20% down is usually fine in that scenario. If credit is not as good, or if the DSCR is a little weaker, you might need to put 25 or 30% down. So kind of depends on those.
I went on mute when one of the kids started screaming downstairs. Sorry about that. Um, Abby, good to see you. Abby asked, "Are there any prepayment penalties for DSCRs?"
Good question. In most cases, yes. Um, on a permanent loan, I keep having to clarify which one we're talking about here. So on a short-term loan, no, there's no prepayment penalties. On a long-term loan, yes, it's usually over a either 3 or 5 year period. 3 year period, a lot of lenders just do like a 333, so 3% essentially, like a 3% like exit fee basically. Going with that 5 year, it's usually a step down, 5, 4, 3, 2, 1. Um, so yeah, usually either a 3 or 5 year.
So if it's a 5 year and the step down, what you're saying is if I, for some reason in year one, want to say, well, I sold the property because this is probably going to happen with us. I don't know. The one that we just refinanced into are I keep getting calls from wholesalers now want to buy it, and I'm like, who sold me to a list or whatnot, and so but what you're saying is if there's a 5 year step down prepayment penalty, year one you're going to pay 5% of the remaining balance, right? On top of that,
Yeah,
that comes into the payoff, and then
yeah,
year four you're going to pay a 4%, year three, year two, and you just continue on, right?
yeah,
Yeah. Okay.
yeah, correct.
Um, let's see. Where was I in the chat? You guys are extremely active in the chat. I love it. I love it. Erica asked a follow-up question. Can these types of loans be called due when interest rates rise and there isn't much equity in the unit? I'm reading a lot about this right now.
Yeah, it's a good question. I don't know that I know the answer to that. Um,
Well, I appreciate you
yeah,
just not making one up.
yeah, yeah, yeah. I haven't had it happen to any of my clients, so yeah, that's the only way I'd hear about it, probably.
Erica,
So
I
yeah,
want
no,
to
I don't. Yeah, that's a good question.
Erica, I want to connect with you offline and talk about that because I've if you're starting to see that happen, I'm just curious on where and what are the circumstances. So,
Yeah, I'm really
uh,
just reading about it right now. And I
okay.
guess it must also be for people who just are, leveraged too much, maybe. But
Mm,
it said something in the article I read this morning that's can become very scary with inflation going up, interest rates rising, that could happen. But yeah, we can touch base. Thanks, Codie. Appreciate it.
Yeah, no problem.
all right, Davian. Davian asked, Davian, you're in Portland, Maine, right? Ask, is this loan leveraging the value of my existing real estate? So, Cody, you got enough there? Or do you need a little bit of clarity on that one?
Yeah, I think I've got enough. Well, do you mean kind of like in lieu of like a down payment? Yeah, be happy to have you come off mute and kind of give some context there. But if 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 that's what you're meaning, then the answer would be no. Um, no, they would still want you to put some cash in the deal.
Oh, I was wondering um, if they would use the value of my building as this is like as like guaranteeing the loan.
Yeah.
If I default on this loan, they could take my other real estate. Um, is that how
Mm,
that works?
No, in most cases, no, like they won't cross collateralize.
Yeah.
It, there are some of there are some scenarios where like I've seen that with like larger like multifamily type properties. If it's like a private debt fund that we're working with or something like that, family office, private debt fund, um, those are essentially private money, right? So like they can kind of just do whatever they want. But kind of these larger institutional lenders, kind of in the single family home world, no, they won't cross collateralize in that way.
great question. Never even thought
Yeah, it
about that
was.
being a possibility.
Yeah.
All right, Cody, I got one for you, and we're wrapping up here on time. By the way, Cody at kbmlending.com is your preferred email, correct?
Yes. Yeah.
All right, Ross, I'm going to drop that in the chat for you and anybody else who wants to reach out to Cody Connect. Ross, I just saw where you posted that earlier. So, all right, so here's my question for you, Cody. And you've got out your crystal ball, right? And you know what the future holds for the next 6 to 12 months.
Yeah.
The rise of interest rates are a pretty hot topic, especially in the mastermind. And even there's one thing I love about the mastermind members is almost everybody that I've talked to within the last week, they're like, this doesn't change the fact that we're going after properties and trying to find properties. We just got to underwrite them differently and make sure they still hit our criteria, right? So, where do you think we're going to be by the end of the year with interest rates? Uh, Disclaimer again, you, this is your opinion. It's for entertainment purposes only, right? So
Yeah.
where do you think we're going to be by the end of the year? And then where do you think we'll go from there?
Yeah. Good question. One thing that I'll say about asset.
Don't dodge the question, man.
No,
Don't
no,
dodge
I'm
it.
gonna give some context. I'm gonna give some context.
Okay.
So
Okay.
conventional loans, conventional lenders are pretty closely tied to the Fed, right, and to rates
Yeah.
associated with the Fed. So when the Fed makes a decision to do something, you see that in the conventional world almost immediately. These asset-based lenders typically go out and acquire pretty large lines of credit at a certain rate, essentially, when they sort of take out that line. So they don't necessarily, like, they're not as volatile, I guess, really kind of on the commercial side, even though, their rates are a little bit higher than conventional rates. They just don't move as quickly as conventional rates do. So,
Okay.
and it's usually because of kind of that lag time behind. They've got that line of credit for themselves kind of already
Right.
set in place. So until they kind of use up that entire line, they don't necessarily have to go and kind of readjust. I don't know. I
You
think
dodged
I
it. Come on,
think I
man.
know. I think rates are. I mean, the Fed is definitely indicating that they're still going to bump them up another couple of times, or maybe a few times. I'll be honest. I probably should know this, right? But I don't even. I think last I heard conventional rates were somewhere around like 5% right now.
Well, it's not
Right?
the world you live in,
Yeah.
and quite frankly, I don't pay attention to it that much because we don't make that many offers,
Yeah.
and so I'm so conservative when I underwrite anyway. I'm typically higher than what it is. So, yeah, and it's not your line of work, right? Like you said, and I didn't know that about the line of work you're in, that you guys aren't as reactionary as a conventional lender. And I've had multiple conversations with conventional lenders over the last month or so, and I feel like every one of them went to the same conference or the same webinar, and because they all gave the same spiel about where we're headed and where we're gonna be in the next, and how long it's gonna be there, and all this other stuff. And so it's great to get a different perspective on that from a different product, which I absolutely enjoy using. I mean, it's incredible. It's the way banking should be. So, anyway,
Yeah.
Thank you for your time, Codie. I got your contact information in there. Oh, one other thing, I'm just going to remind everybody. I know we've had some people drop in and out. I'm going to put some links in the chat. It is the way that you guys can communicate with us. The very first thing I want you guys to do is make sure that before you in the Zoom call is put a calendar reminder, whatever calendar tool you use, Friday at 4 Eastern, 3 Central. We're going to have a happy hour where we all can come together, do a little networking, just social gathering, whatnot. We'll do breakout rooms, so it's not like 40 people in a room everybody trying to talk over one another. We'll narrow it down. A lot of the presenters are going to be here. I'm going to be here. A lot of the membership strategists and whatnot are going to be here for that. So we'll spend a couple of hours talking about whatever you want to talk about. We do this once a month with the W2 Capitalist Mastermind and the pro community, and it's a lot of fun. So Friday at 4 Eastern, mark it on your calendar, and there will be a link that is sent out. If you don't grab the link today or register through that link today, and I'm pointing at that screen as if you guys can see that. But there's a link right there. You will get an email reminder about, I think it goes out 15 minutes prior to this event. So, guys, that's it. That is a wrap on day 3 of the W2 Capitalist Virtual Summit 2022. We're going to continue this tomorrow with Chris and Maricela. I see them here on in the gallery here. They're going to be talking about passive investing, multifamily investing. There they are. Always crushing it. I'm super excited to hear from them. And then quickly following them is going to be Masha Klapanova. She's going to be talking about why self-storage is such a hot investment right now. Personally, it is an asset class I'm trying to get into, and I'm failing miserably about that. So anyway.
It begins with a thought, an idea that keeps growing in your mind. You spend days, months, or even years just simply thinking about it. There are many ways to get started, take action, and make progress, but both you and I know the best way is to have a guide as you surround yourself with like-minded people. Peers who are on your level that are actively taking the next step. You'll feel empowered and your confidence will breed confidence. Having so many options to choose from when purchasing a real estate investing educational program, you'll soon find out that just a few will understand your thoughts, your fears, and your expectations. For the next 6 weeks, I will be your coach. Grasp your vision, create realistic goals, and diligently apply what I've learned from investing since 2014, and deliver a framework for you to build your experience and portfolio. Seating is limited. Register today.